Hey guys, welcome back to my channel. Today we're gonna do a market update just to see, what's been going on recently in the past few days, and where there might be some opportunities for you to invest, or where basically I see it that you have opportunities. So if we're looking at the market today, we actually see that across the board, large cap especially are all up. Tesla 4%. Microsoft, Google, all around 1%. And then, as you can see, as the squares get smaller, which indicates a smaller market cap, the losses appear to be bigger. So Goldman Sachs 3%, PayPal 2%, healthcare as well. So it was kind of a mixed day as well today. One of the big news that related to that is the inflation data from the US that has been released for the December month. So we had a jump in over 7% in the December month of inflation as prices rise even further, and the market had an expectation that would be around at a higher end of the 6% range. But now this was a sort of a little bit of a surprise to the upside, which obviously the smaller the company is, or the less profit it has, it will actually affect it even more negatively. So and we can see that quite easily if we go to the S&P 500 for the day, which is up slightly, basically been trading over the past 5 days slightly up, and is, as you might know, the S&P 500 is including the 500 largest companies in the US, and the top 10 make up around, I think it is 20 to 30% of that index. So as we can see, as long as those big companies are holding up well, the overall index is doing well, basically. Comparing that to the Russell 2000, which includes all 2000 companies, kind of smaller cap companies in the US market, that has actually been trending down the past 5 days, and today as well, right around when we actually had that announcement around that higher than expected inflation rate, which was 7%, as I mentioned before. We can definitely see that since then it's been trending down. So this is what I mentioned in one of my previous videos earlier, that actually there is this kind of disconnect of what the market looks like if you're only invested in your, let's say, index funds as an S&P 500, like the SPY, for instance, which I show here. You would actually not notice that there is a sort of a bear market going on in a particular area of the market, because if you look at the past month performance, it's up. Past 6 months up 8%. For the year, it's slightly down, but 1 year backwards, you're up significantly, 24%. Whereas when you look at the Russell 2000, which includes way smaller stocks, for the year, you're actually quite flat. You had these bumps up, and they came straight down on new inflation fears or new rumors that interest rates might get increased earlier than later. You had that, a rise from up to 50%, which quickly came down again once we had that confirmation that interest rates are not gonna be raised in 2022, and probably around 3 to 5 times now. So we have that confirmation, and your smaller mid to small caps, you're really going flat over the past year. So there's this disconnect there, and to make it even more visual to you guys, I found this graph, which is quite a good way to actually illustrate what's been going on. So you have 3 graphs here. One is the S&P 500 large caps that we were talking about. We just showed that. Then you have the S&P 500 400 mid caps, which go sort of in the range of, I think it's 10 to 50 billion. And then you have the small caps, which is anything below that 10 billion, so more like $1-2 billion market cap. And you can actually see that, this is a graph of their forward PE, price to earnings ratios for, so basically what is the next 12 months projected to earn given the stock price today. And then you can see that for the large caps, they're really at an all-time high. I mean, this graph goes back to 99, and you can see that the range that at right now, which is around 21, this is one of the highest that we've seen in the past 20 years. I mean, it goes basically back to the dot-com bubble, which, you know, PE ratios were tremendously high and then came crashing down, as we can see here. We have a similar high level right now, and I mean, it really makes sense if you look at stocks like Apple, for instance, that have been performing over the past year, Google, Microsoft, and they just haven't adjusted down. They've just been straight going up and up. So if you actually look at Apple, for instance, there is no correction at all. It's just been going up and up and up. And PE ratios here is now 31. So that's definitely high. I think it's the highest that Apple has ever traded at, whereas Apple is now the most advanced it has ever been. So you would actually expect growth to slow down, the PE ratio to come down, but it's just right now we see the opposite happening. The PE ratio goes up as the growth slows down. So this is definitely a warning sign for sort of those large multi-billion-dollar cap companies, that they might be due for a small correction here, because we can see that mid and small cap, they definitely had that correction. We can see that after basically COVID hit, we had this huge drop of that shock news. Everything went down. Then we had that huge rally up again because of the Federal Reserve keep pushing money into the system and continue their quantitative easing measures. And then you could just see that how the large caps have been holding up that trend and haven't really come down and haven't really corrected, whereas the mid and small cap have also shoot up, but then have like straight away beginning of 2021 they've corrected down ever since, and they've still in a sort of a correction mode right now where we don't know, is it gonna go down even further, or are they like at a level where you know, it's gonna level out and then they're gonna correct upwards maybe. So you can actually see that this type of level, around 15, 16 forward PE ratio, the last time we had this really happening, if you go here on the small caps, I mean for a period of time, not just for 1 second here as in COVID, but the last time we had this happening was basically 2010, 11, 12. So then we had like these 2 years of a sideways consolidation basically for mid and small caps, and yeah, this is really the last time we had this happening. So if you think about it, that seems to me that if you look at an average, seems to be mid and small cap should be more around a 17 to 18 forward PE ratio, whereas they're trading now at a 14 to 16 PE ratio. So definitely that's where the opportunity is right now. And I mean, you've been seeing that in the news because of the interest rate hikes, or the announcement of interest rate hikes and the higher inflation. Growth stocks and small stocks that don't make yet profit, they have been going down and down and down. This is what's reflected here. So I think that's where the opportunity is for you right now to actually have a look into them more closely. And what are some of those stocks? I mean, we're talking about things like HIMS and HERS, which is a healthcare telehealth company, quite new to the market. They've just been performing very poorly since their IPO, basically down 43%. Then you have stuff like TDOC, which I made a video about yesterday, also been going down basically 70% from their highs in February 21, which is pretty much aligned with exactly this graph here. And then, so companies like that, this is where there's opportunity for the upside now. And if we go scrolling down here, same thing really with the price to sales ratio. So what is the revenue to stock price ratio for large, mid and small caps? So we can see that large caps, they've just been going through the roof. I mean, they've been trading for their highest pretty much ever. So a 3 price to sales ratio for a really, really large company. I mean, this also includes banks and large healthcare companies. This is really not what we want to see. Like those mature big companies, they usually trade at a 1 or even less than 1 price to sales ratio, which we can see they had been doing sort of in the previous years, which goes here all the way back to 2004, and compared to exactly the mid and small cap, which usually trade at a price to sales ratio a little bit above 1. They've been now correcting down towards, small cap even trading almost below 1, which is sort of not a common theme for them, because obviously if you have a small cap company that is new and growing like HIMS and HERS, you would expect them to grow their revenue significantly so that you can be okay to pay anything below 10 as a price to sales ratio, because the revenue is going to grow exponentially in the upcoming years, so that price to sales ratio will correct down and will just momentarily look high for you. Whereas if you have something like a Johnson & Johnson or JP Morgan, they have a huge revenue already, and they're not going to outgrow that to be even double up or triple up in the upcoming years. So that the price to sales ratio should be at around a 1, because you don't expect that huge growth. Whereas when you have a HIMS and HERS or TDOC, they're growing revenues at anything from 50 to 80% sometimes. So that price to sales ratio next year, for what you pay right now, if you pay right now a 5 to 7 price to sales ratio, next year with that 50 to 80% growth, that price to sales ratio might be only 3% or 3. So yeah, this is definitely something to look out for. I mean, if you ask me where the opportunity is, it's definitely in that mid to small cap range. I wouldn't put too much of my money right now into those large caps like Apple and Microsoft. I just don't see that upside potential anymore. I mean, people treating it as if it's sort of a kind of like a bank right now, because they've just been seeing it going up, so they just expect whatever has happened in the last year, those are the winners, and they will keep winning and they will keep going up forever. But this is just not how it works. Like you should always be looking for, where is the disconnect happening, what has been going down, assess why it's been going down, find good companies, and then invest into those downward trends, because this is where you make the money once it shoots up again. You're not making money by investing in companies that have already been going up for 1 or 2 years consistently without any correction. So what are you going to expect? You expect them to be at a price to sales ratio next year of like 26? I mean, you can see that when we had this type of scenario in the dot-com bubble around 2000, it's been correcting down sharply. So there's definitely a danger element there if you invest too heavily in large caps. Could mid and small cap go down? I mean, yeah, surely they could go down even further. I mean, they could go down to like a 14 or 13 forward PE ratio, but that would mean that it's just even more attractive to buy. So I would not just put all of my money right now into the market. I would do it step by step, sort of slowly identify those nice, strong, small to mid cap companies that you want to invest in that had that weakening happening in price action. Slowly invest in those and then see where they're going, if they find a bottom here at some stage and then they keep going up. I mean, you will make money buying them from here onwards down to the bottoming up, buying again, and even if you buy them on their way back up to their mean, you still make money if any price you buy is below that mean forward PE ratio that they usually have, which is in that range here, in that 17 to 18 range. So anything that's below that, you're pretty much pretty sure to make money over the long term, if of course you pick the right companies. Yeah, so I'm gonna show you some of those right companies in my videos going forward. I'm gonna do some deep dive analysis on those, and then yeah, hopefully this video today was helpful, and let me know in the comments if you would like me to cover anything else. And yeah, see you next time. Bye.